Another thing this chapter introduces is the strategic focus of cost management. So these are Kaplan's phases for developing cost management systems. In stage one, we just use cost management systems for basic transaction reporting. We don't have a complex system in place where our cost management information is an integral part of all of our strategic decision making. In stage two, cost management has moved on to external reporting and making sure that we have reliable reports. We have limited usefulness for the data that we have available for us because we're just using it for both the transaction reporting systems in stage one and for the external reporting requirements. When we move into stage three and stage four, we're really utilizing this cost accounting information for our decision making and our strategic decisions as part of the company. We've integrated all of this information into what we need to make well-rounded decisions about the future of our organization. So, how have the changes in the contemporary business environment affected the cost management, the management accountant? The management accountant needs to provide information. We need to keep up with the ever-changing business environment. We need to know how the environment is changing so that we can adapt. We have critical success factors that we're going to talk about in many of the chapters. We're going to delve a lot deeper into those critical success factors, or CSFs, in chapter 2. So these are performance measurements for our competitive advantage. As business becomes more competitive, because we have more people entering, we have technology giving us unlimited access to the internet, we have to be strategic about how we're reaching our customers and how we're keeping our customers. So we're going to talk about these contemporary management techniques that we'll be looking at throughout the course of this semester. The first one that we're going to be looking at is the balance scorecard and strategy map. We're going to look at those much deeper in chapters 2, but we're also going to see them in 12, 18, and 20. So the balance scorecard is a performance management tool that looks at how a company is performing for financial and non-financial measures. So we have 4 different perspectives in a balance scorecard. We have the financial measures, the customer satisfaction measures, internal processes, and learning and growth. And learning and growth can include, how do we develop our employees? How do we train our employees so that they become better at what they are doing? Then we have a strategy map. This is based on our balance scorecard. It is a pictorial example of the information that we've included in our balance scorecard. The balance scorecard has the same setup in that we cover those 4 perspectives and we include financial and non-financial data, but each balance scorecard should be individual to the company that is measuring. The value chain. We're going to talk a lot about the value chain. We're going to talk about it some in chapter 2, and then it comes up again in chapters 13 and 17. So we look at, when we're talking about the value chain, that is everything that happens from product conception or service conception, from the moment we have an idea about something through the customer, getting that to the customer, and customer satisfaction, and everything in between: development, marketing, sales, customer support. Everything is included within the value chain. What we're usually looking at in the value chain as a management accountant is which steps can we eliminate to reduce costs, which ones need to be improved to better serve our customers, which ones can we have someone else do. We're looking at ways to lower costs while increasing value. Activity-based costing and management. So we talk about activity-based costing and management in Principles of Accounting 2. And this is a popular way of how we trace costs and overhead to our product, services, or our customers. We're going to be looking at activity-based costing and management much heavier in Chapter 5. Business analytics. We have a lot of data, and we have almost unlimited access to data in today's world. Data management is a huge part of accounting. So the Certified Management Accounting exams and the Certified Public Accounting exams and the CPA exam are both undergoing changes to include more business analytic in their exams. Accountants need to be really focused on data management, on how we use that information to understand our business performance and to make strategic decisions about our business. Target costing. Target costing, that also comes from our intensely competitive markets. Consumers are only going to pay so much for an item. So we have the market determined price, what the consumer will pay, minus our desired profit. And then we have to fit that product or service cost into that target cost. Life cycle costing. Research and development is expensive and it takes time. So we keep track of costing throughout the entire life cycle and put that as part of the product's cost. The product cost isn't just its direct materials and its direct labor. If we paid millions of dollars to develop and test the product over an extended period of time, those costs, we need to try to recoup them in some way. Now, life cycle costing is for different businesses and markets. This is more relevant to pharmaceutical companies and some tech companies that have extensive research and development costs and times. Benchmarking. So benchmarking is where we compare ourselves with the best practices in industry. And then we try to make ourselves the best in that industry. But how do we compare with other in our industry? So if we're a retailer, a major retailer, we're working for Target, how do we compare to Amazon and Walmart and any of our other retailing competitors? And how can we develop better market niche? So instead of going to Walmart, our customers are coming to us. Process improvement. This is a huge thing in manufacturing, and it's becoming a much more business-oriented thing too. Continuous improvement. We're always looking at ways to improve what we are doing. Can we make it more efficient? Are there tools that we can use that make us better at what we're doing? When we're looking at all of the data analytics that we have to manage, are there better ways in which we can do that? Are there different software programs? And which one is better than the other? All of that is part of continuous improvement. Total quality management, or TQM. So this also goes back to the balanced scorecard and lean manufacturing and lean management, but it's a holistic picture that looks at how are we doing our business to exceed our customer expectations and make the profit that we want. And then lean accounting, which goes hand in hand with lean manufacturing. That also goes hand in hand with the value chain. because we're looking at how can we cut things out. That's where lean comes from. How can we cut the fat? How can we trim the fat and make lean processes that make sense and have maybe lower costs that are more efficient? The theory of constraints. So in the theory of constraints, we look at what are our constraints, especially in production. And some of those constraints are there are only so many hours in a day. We only have so many employees. We only have so much money. So how do we look at those things and be the most efficient that we can? If I'm trying to produce a certain number of products and I only have 8 hours a day, products or services, how can I fit the most within those constraints? Sustainability. We're going to look at sustainability in all chapters. So sustainability is a very large part of business now. A lot of that comes from customer demand. Customers want to trust businesses and they want to believe that businesses are doing things to protect the environment. A lot of companies produce sustainability reports, and those reports contain financial information also because sustainability can be expensive. It can also help in our cost management. And then we're going to look at enterprise risk management, or ERM. So this is where we manage our risks, and risk can be anything. It depends on the industry, it depends on what we do, and we have internal risks and external risks. So how do we succeed as a business? We need to be able to adapt. We need to know what is happening. So our cost management, we need to understand how we operate in order to understand how we can adapt those operations moving forward. We want to make long-term plans and then short-term plans and goals to help us meet those long-term plans. We have two main competitive strategies for companies when we're looking at the next couple of chapters. In chapter 2, we're going to look at cost leadership and differentiation much more. So cost leadership is that we outperform competitors by offering the lowest cost, but we're also offering high quality so that our quality is just as good as any of the other products on the market, but we're able to do it at a lower cost. Differentiation is that we create value for the customer. Either our innovative products or our features, our customer service. And this is when the customer is willing to pay more for our added value. So I'm willing to pay whatever the company charges because I'm a loyal customer. And there's a reason I'm a loyal customer, because I want what that product offers that I can't find in another product that's cheaper. Or that product offers me great customer service. So I'm willing to pay more for that added value. That's cost differentiation. So this table has some examples of what those look like. We're also going to have the 5 steps of strategic decision making. We're going to look at those 5 steps. Those will be in every single chapter. First is, what are the issues? What's our problem? We have to determine what our problem is before we can look at ways to solve that problem. So the first thing that we do is find our problem. Then we start identifying the different actions we can take. In step 3, we're going to collect as much information as we can so we can conduct usually financial analysis of the alternatives. Which alternative is cheaper? Which alternative is more efficient? Then we take all of that information and choose which one of those alternatives we're going to implement. In step 5, we evaluate our decision. And then we repeat that. Did that decision work? Is everything being effective? We're going to continue evaluating it, and we might have to start over at one of the previous steps. Maybe the effectiveness of that wasn't great. And so we need to go back and look at our information and our analysis and our alternatives and choose another alternative. Maybe we need to scrap everything we had before and come up with new ideas. As I said, we're going to see these 5 steps of strategic decision making in every chapter. We have professional organizations in accounting. There are a great number of professional organizations, and this slide and your textbook just name a few. The main organization for professionalism and expertise in management accounting is the Institute of Management Accountants. Okay. We also have multiple certifications. I see now that says 3 important certifications, and I have 4 listed here. That CSCA is a new certification that is offered through the International Management Accounting Association, or the IMA. So the CPA is the certification that most people are familiar with. This is public accounting. There's also the CMA for certified management accounting. We have a certified global management accountant for international accounting. There are also other multiple certifications outside of these certifications that aren't listed. There's government accounting certification, there's internal auditing, fraud certifications, financial accounting certifications, financial manager certifications. Some of them are listed in your text, but there are others available. What I usually would suggest is that you find the ones that are most relevant to your profession and the ones that your company is willing to pay for you to get. The last thing in this chapter is the IMA statement of ethical professional practice. A lot of the accounting regulations that have come about in the last 20 years have come about because of fraud issues. We want companies to be trustworthy. We want our consumers to trust that our financial information is ethical, that we're not committing fraud. And so every business, every professional organization has its own ethical statement. So the IMA statement says that when we're presented with an ethical issue, that we're going to discuss it with our immediate supervisor first, unless the ethical person is our immediate supervisor. Then we're going to look at one of the other people to consult. Our standards are competence, integrity, confidentiality, and credibility. And what these standards basically state is that we're going to do the best in our power to be ethical with our financial information. The competence standard says that we're going to continue professional development. So we're always keeping up with the new rules and the new regulations and the new information out there. So we have the highest standards of our professional practice. That is the end of chapter 1.